So thank you very much for inviting us and allowing us to present our paper here. As the title suggests, this is a paper about government borrowing and its impact on corporate finance. And one of the things that I need to convince you of is that looking at crowding out the impact of government borrowing on corporate financing when it first started back in the World War I era is still relevant for thinking about issues of government borrowing and corporate debt. So a couple of things that to start with in terms of similarities. The World War I was it was the first time that the US government actively engaged in trying to sell a large amount of government debt. In terms of government borrowing relative to nominal GDP, as the chart indicates, during the war.
Christopher, can you share your screen?
Oh, sorry.
Yep.
All right. Let's see if that works. You see it?
Perfect.
Yep.
All right. Yeah, the graphics are a little better if you see them. So if you look at the first chart here, you'll see that the increase in government borrowing during the war years was similar in magnitude to what we're currently observing today. So in terms of an increase, it went from about zero borrowing relative to nominal GDP prior to the war to a total around 34% of GDP. So a large increase. And the question we're going to address here is, what impact does a large increase in government borrowing have on corporate financing decisions? And as I'll explain, we're going to try to look at both the impact on aggregate corporate borrowing as well as looking at particular types of securities that are likely to be impacted by a large increase in corporate debt. So what's the paper about? As I indicated, it's about how government debt affects corporate financing. And for those of you that are familiar with this literature, you know that it's been both widely, that question's been widely examined and has faced substantial challenges. And the big challenge here is identification. It's hard to make causal statements because government borrowing tends to be endogenous. So you see large increases in government debt during recessions, current pandemic is an example, those are likely to be related to things like investment opportunity and corporate demand for financing. So disentangling the impact of government borrowing from other macro events that led to the government borrowing is a challenge. In addition, as those of you that are familiar with the literature, people have struggled with trying to figure out just exactly what securities that the corporate sector or the financial sector issues that are close substitutes for treasury bonds and bills. So some papers have suggested that, treasury bills and the debt of financial institutions are close substitutes because they're money-like. Other papers have looked at long-term corporate bonds as being a close substitute for the treasury bonds. Figuring out what securities are likely to be affected by a government bond issue is subject to a substantial amount of debate in the literature. The other problem that we have in trying to identify links between government borrowing and corporate financing decisions is that in today's world, there's a well-defined schedule of treasury bond issues. I'm going to show you probably doesn't show up very well, but you can go to the Treasury's website and download the schedule of auctions that are going to occur over the next 8 months. So we know today, for example, that there's a planned offering of 5, 10, and 30-year treasuries in October of this year. And if you sort of look at this chart, you'll see there's a fairly well-defined schedule in terms of which times during a month the Treasury is going to be active in trying to auction off its securities. So what we do here is use your World War I as a way to identify shifts in the Treasury supply and the response of corporate borrowers to those shifts. And we can do this because of some interesting and somewhat unique features of government borrowing and corporate financing during the early part of the past century. So the first part was that the Treasury made irregular offerings, in contrast to the chart that I just showed you, as I'll explain in some detail. The Treasury was reluctant to provide investors with information regarding upcoming offerings. In large part, it was based on a concern that disclosing the size of the offering or the coupon rate associated with a particular offering in advance of the offering, and then having to potentially modify terms as the offering came up, would be perceived by investors as sort of weakness in the Treasury market. There was a big concern during World War I that the amount that the Treasury was able to raise, or the terms at which it raised its financing, would provide our adversaries with information regarding the dedication or the ability of the U.S. to carry out its war effort. The other interesting aspect about the issuance of government debt during World War I is it was not auctioned like it is today. It was marketed. Okay, so there was a Liberty Bond campaign, as I'll explain, in which volunteers were enlisted to try to go out and market these securities to investors and some financial institutions. So there wasn't an auction, and as I'll explain, what occurred was the Treasury would set a coupon rate prior to the offering, disclose almost contemporaneous with the offering an amount that it was going to attempt to raise, okay, and then it restricted the sale of the securities to be at par, so you couldn't sell it a premium or at a discount, okay. And then the final aspect of the government bond issuances was they occurred in discrete intervals, and as I'll explain, and as a prior chart illustrates, the intervals, I think there were 5 during the Liberty Bond campaign, they were substantial amounts of debt relative to GDP. In terms of corporate financing at the time, again, as a way of motivating our identification, firms tended to announce an offering before each security offering. And then most important, unlike today, most securities were not offered to investors using a firm commitment underwriting. Rather, the offerings occurred through either a direct marketing or a best efforts underwriting. So to the extent that a underwriting syndicate was formed to market the bonds or the common stock, the underwriting syndicate did a best efforts. Oftentimes, there was a direct marketing. So the issuer themselves would go out and try to solicit purchasers for the securities. This is a little fuzzy. It comes out of Dewing's corporate finance text as an example of direct marketing. So you have a large rubber manufacturing company that is getting a demand by its bank to pay down the bank loans, and the company has salespeople that are not fully employed, so they send them out into the field to market the preferred stock for to their customers. So here's how we go about trying to identify the impact of government borrowing on corporate finance. We're going to start by calculating the difference between the issue amount that the company announces and the amount that the company actually raised. So you can think about this as a difference between what the company was seeking versus what it was successful in raising. And we're going to define a term. The unsold amount is the amount that was offered but was unable to be placed with investors. And then we're going to compare the unsold amounts in months in which the Treasury was borrowing, and we know when that time period was, to when the Treasury was not marketing. And we're going to see and investigate whether the unsold amount varies systematically with Treasury involvement in the market, number one. And number two, examine the extent to which unsold amounts when Treasury is active varies by the type of security offering. So were long-term bonds, corporate bonds more affected than, say, shorter-term borrowing, common stocks paying stable dividends, more impacted than, say, growth stocks, or again, short-term borrowing. The main findings are as follows. We find that long-term government bonds tended to crowd out long-term investment-grade corporate bonds. So the unsold portion was larger for investment-grade bonds than for, say, speculative-grade securities. We find no impact of government borrowing on short-term corporate note issuance or speculative long-term bonds. So the impact in the bond market tends to be in the long end of the market, and as I'll explain in a minute, that's precisely where the government was borrowing, in the long end of the market for most of the campaigns. The other interesting thing we find is that government borrowings had a significant impact on the issuance of common stock and preferred stock, but only those common stock issues made by issuers that were paying regular, predictable, stable dividends. So the implication of all this is investors seem to view stocks without stocks with stable dividends, that's a typo, as close substitutes for government bonds, which is consistent with some behavioral theories and empirical work that's been done recently by Hartzmark and Solomon and some others, in which they argue, look, investors have a behavioral bias in the sense that they disconnect the dividend payment from capital gains. So they view dividends as almost like a free dividend, or what they refer to as the free dividend fallacy, and don't attribute and recognize that dividends come at the expense, obviously, of capital gains. Our results, I think, help explain a recent finding by Baker and Wergler and some others that government bonds returns tend to co-move with bond-like stocks. Again, stocks that have stable dividends from companies that have relatively stable earnings and relatively low growth prospects. So that, in summary, is what we're going to be doing and what I'm going to be explaining in this talk. And I'll try to explain to you later on why what we're finding in this paper may be relevant for understanding the degree to which various securities are substitutes for government bonds in today's environment. So before I go any further, why don't I stop here and see if there's any questions that I can answer before I get into the details.
All right, very well. We have plenty of questions at this moment already. So in terms of the external validity, do we expect that your results will only be valid in the circumstances of irregular treasury bond offerings? Do firms behave differently in the world with the scheduled treasury auctions?
No, I think that rather than an issue of external validity, I think that the irregular treasury auctions of World War I help us to identify the impact. I can't think of why the regular schedule of dividends, of treasuries, would impact the degree to which investors view treasuries and certain corporate securities as substitutes for one another. As I'll explain later on in the presentation, I have a slide at the end regarding sort of the general issues of external validity in terms of the treatment of dividends, in terms of taxes, characteristics of the securities markets today versus World War I, to explain whether the results that we're seeing for World War I qualitatively are similar to what we would observe or are observing today.
Okay. Why do you think some of these characteristics did not hold during other times of stress, such as World War II?
Well, I'm not arguing that they didn't, but I think that the identification is a little easier, frankly, for World War I as opposed to World War II, partly because at the beginning of World War I, excuse me, the U.S. was close to full employment. So the run up to World War I, or U.S. involvement in World War I, was as follows. The war began in 1914, and the U.S. was a major supplier to Europeans that were actively engaged in the war. The U.S. didn't enter the war until 1917. So at the time where the U.S. was ramping up its borrowing, the U.S. economy was close to full employment. So if you're going to see a crowding out effect, you're going to likely see it when you have close to full employment and vigorous investment opportunities. In contrast, at the beginning of World War II, when government began borrowing significantly, there was substantial excess capacity and unemployment. I think at the beginning of World War II, the unemployment rate was somewhere around 14–15%, with a large amount of excess factory capacity. So something different from what we observe at the beginning of World War I.
Okay, were U.S. treasuries as safe in 1918 as they are today? Perhaps they were less safe and more substitutable with corporate bonds. Does your identification assume that the amount announced is exogenous and the amount raised is endogenous? It seems that there is a joint hypothesis problem between, first, the unexpected demand for corporate bonds, and second, the ability of the issuers to predict demand.
Good question. And I think that I'll try to convince you that predicting both the size of the issue and the terms of the issue was challenging in the World War I era, partly because of the lack of transparency by the Treasury in terms of what it intended to issue in the terms before the issue was announced. And second, the very peculiar nature of the way in which the securities were marketed. So you've got, as I'll explain, a fixed coupon rate and the requirement that you're going to sell at par. And as I'll explain in a minute, you see that the Treasury didn't do a very good job of anticipating investor demand. When we have data on the amount to which Treasuries were oversubscribed during this period of time. And as I'll explain in just a second, the oversubscription rates were very, very large during the first couple of Liberty Bond issuances. Oversubscription rates declined later, and we observed, consistent with sort of an unexpectedly large demand for the Treasuries at the time, as evidenced by the size of the oversubscriptions. When the amount of oversubscriptions are declined in later issues, you see less of a crowding out effect associated with those. Well, one more question, and I probably should move on. Anybody still there?
I'm sorry, I muted myself. So okay. I'm going to leave a bunch of questions which are related to methodology and the results until later. But at this point, at the very first slide, you have showed that the government debt is supposed to increase very sharply in 2035, 2050. Can you please comment on that?
Well, these are projections done by the Congressional Budget Office, and I should add, they are projections as of January of this year. They do not incorporate the COVID-related borrowing that spiked beginning in March. So the dash line there is projections as of January of this past year.
Okay, thank you.
Sure. All right, so let me just sort of outline where I'm headed. I'm going to explain a little bit about the empirical strategy, try to give you some background information on what I think is a very interesting period in U.S. Financial history, the funding of the First World War. I'll explain some of our baseline estimates, look at mechanism, and then talk a little bit about relevance. So as I mentioned, government debt increased significantly during the First World War after the U.S. entered. And in this graph here, I wanted to make a couple of points. First, prior to World War I, government borrowing was relatively modest relative to GDP. So the typical borrowing for the U.S. government would be on project-related things such as the Panama Canal and some cash management borrowing, but not a substantial amount of GDP. The other interesting thing is that prior to the establishment of the Federal Reserve, Treasury bonds were used to back national banknotes. So there was not a well-developed investor market for U.S. Treasury debt before World War I. That was a phenomenon that occurred as the war financing began, and the World War I was really the first attempt to place a large amount of Treasury debt with financial institutions other than commercial banks and individual investors. There was an unconventional strategy, which was much like how corporate debt was being issued. The Treasury was going to market directly to individuals and institutions. So a large amount of marketing went on. I have three pictures on this slide. The first is, you buy the Liberty bonds, we'll do the rest. The second is this graphic that says, you know, let Uncle Sam take this, which is your money, and he'll give you back this, which is your investment plus interest. But what's interesting about the diagram is this, which is all he asks is that you keep the bond, buy them and keep them. In other words, the government discouraged an active secondary market from developing for Liberty bonds. Again, this was this notion that to the extent that there was an active trading in the bonds, fluctuations in the interest rates on the bonds would give our adversaries some information regarding the backing of the public of the government's war effort. And then the final, and I promise this is the last COVID-related comment I'll make, is this is the parade in Philadelphia in 1918 that was designed to foster interest in and generate interest in the Liberty Bond campaign. It occurred in October, I believe, of 1918, and it was followed by the second wave of the influenza, which was particularly, for which Philadelphia was particularly hard hit because of the crowds and the like. So here, some background on the Liberty and Victory Bond offerings. There were 5 of them. There was no auction, as I indicated. They were required to be sold at par, and the coupons was set before the offering. The amount of the offerings varied from around $2 billion to a high of 6.87 billion, and just multiply those numbers by a factor of 25 to get the equivalent value in 2019 dollars. What's interesting is, from a researcher's perspective, is the Treasury varied the maturity of the issues over time. So the first one started out at 30 years, and the Victory Bond campaign was 4 years. And then you had this third Liberty Bond at a 10-year. The others were 20 and 25. The subscription rates are in this last column here. So the oversubscription for the first offering was around 52, 54 for the second. Then it drops down for the last 2 to 17%. So there's some evidence that if you think about this oversubscription rate as an indicator of money left on the table, that the use of a direct marketing campaign as opposed to an auction probably led to higher borrowing costs than an auction would have yielded. So we just briefly where we get data. We get bond offering data from stock offering data from 2 sources. The Moody's Daily Digest of Corporate News, which basically is information that Moody's collected from news offerings and offering circulars regarding prospective issues. Then a second source, and I'll explain the importance of this in just a second, was the Capital Issuance Committee record. So beginning in March of 1918, issuers were required to notify the Capital Issues Committee as to whether they intended to make an offering. And what that allows us to do, those records allow us to do, is to track offerings that where firms were intending to issue securities, but it canceled the offering and didn't announce the security. We collect information on securities offerings from these various sources. We're going to look at long-term bonds, common stock, and preferred stock. Unlike today, where preferred stock is not typically issued by publicly traded companies, it's still issued by a lot of private startups. Preferred stock was a widely used financing tool prior to World War II. We're going to have control variables for ratings, information on whether a firm's profitability, asset size, and leverage. We're also going to control for whether the firm had a work contract to try to identify firms that may have been involved in the war effort and may have gotten special treatment in terms of the ability to issue or particular investor interest in their issues. And then we'll include some macro controls as well. So the key variable here that we're going to examine is what I'll call the unsold ratio, which is the difference between the amount that the company announced and the amount that they actually sold relative to the announcement amount. Okay, so simple example, if I can do that. I'll come back to that. So calculate the amount announced, look at the amount that were successfully sold by going to the Moody's manuals after the offering relative to the announced amount. So here's an example of some anecdotal evidence regarding unsold amount where a particular copper company is issuing convertible gold bonds and it is unable to successfully place them and the syndicate is dissolved. What we observe, here's just a sort of a summary of our results. The gray bars are periods over which the Liberty bond marketing campaigns were occurring, and the red dots are various securities offerings at various months. And you can see a pattern here, or at least I do, of the unsold ratio increasing during periods in which there was an active marketing for government debt, and then declining during the periods in which the Liberty bond campaigns were not ongoing. So here's what we're going to do in terms of trying to identify an impact. We'll compare the unsold ratio in treatment months, where there's a Liberty bond issue going on, to the unsold ratio in control months. And we're going to define treated months as the month before the campaign and a month after the campaign ended. So we'll have basically a 4-month period of treatment, and then in those months in which we're not observing a campaign that's about to begin or has ended, we'll treat as control months. So for example, during the first Liberty bond issue of April 1917, the treatment months are March, April, May, and June, and we're going to use the remaining months as control months. As I'll explain a little later, our results are robust to a tighter window around the offering campaign. I'll explain that in a second. So some summary statistics. Most of the issues in our sample are either long-term bonds or short-term notes, just as in today's market, common stocks and certainly our stock offerings are rarer than bond offerings. And we have about an equal number of common stock and preferred offerings. So here's the specification. Let me go through this and then I'll stop. I'll show you some results and then I'll stop and take some questions. So we're gonna basically estimate a difference in difference model in which we're gonna look at the unsold ratio for security I offered by firm J in month M in year T, and we're going to look at how that varies with the amount of federal government debt issued relative to nominal GDP, controlling for firm-specific factors, having securities controls, whether it's a common stock, long-term bond, short-term bond, and the like. We'll have sector and year fixed effects, so manufacturing versus utility versus railway, and year fixed effects. Here's our main result. The unsold ratios increase for all securities except short-term notes. So we find a positive and significant relationship between new federal debt issue in relative to nominal GDP and the overall unsold ratio of securities. Okay, it's larger for corporate bonds and common stock. And in fact, we can't reject the hypothesis that the impact is the same for long-term bonds as it is for common stocks or preferred. We can reject the hypothesis that they say that short-term notes are impacted in the same way as long-term notes. So the first takeaway here is government was issuing primarily long-term debt, and the impact that we observe of those issues is primarily on the ability of firms to sell long-term debt and common stock. And I'll dig deeper into this, these relationships after I take a few questions.
Right, very good. So this kind of relates to probably one of the earlier slides. So could you please comment on how yields were affected with each new tranche? It looks like, over the time, the government had to offer progressively higher and higher yield.
Yeah, so remember, these are nominal yields, and there was some inflation during this period of time. I recall, and I have to go back and look, but I think the real rates were relatively stable over this period of time, but I'd have to check, and at the end of the seminar, maybe Mary or Chad can address that issue. But my recollection is relatively stable real rates.
Do you find that crowding out of long-term corporate bond market led to substitution in the form of private borrowings loans?
Well, I'm not sure I fully understand that question. I think what this is telling me is that the impact of, say, a large treasury issue in the long end of the term structure, which most were, had the largest impact on the ability of corporations to sell long-term debt and stable dividend-paying stocks. So the two takeaways I get from this is it's targeted at a particular part of the term structure, and I'll provide some additional evidence of that in just a minute by looking at variations in the maturity of the offerings in the various Liberty bond campaigns to this unsold ratio of long-term and common stock, and how it varies over the time period. The second thing is that we're likely to understate the impact of government borrowing on the offering of corporate debt and common, for the following reason. We're not going to rule out that corporations might have anticipated additional treasury bond issues, and they have anticipated the issues would be structured in a way that was similar to prior issues, and thus reduced their didn't announce offerings or postponed offerings until periods of time in which either the Treasury wasn't in the market or waiting until and postponing investment until after the war.
Okay, you are probably interested in whether crowding out had real negative effects. Is there a way you can address that? One way to approach this is to see whether those crowded out return to the market earlier than others?
So a good question, and I think that and that's something we could look at. I, I I think we can get at some issues of more granular issues of crowding out by, as I mentioned, trying to take a look at how variation in the offering terms that the Treasury had in terms of maturity impact, say, long-term bonds versus short-term notes and common stock differently.
Have you considered examining the impact on municipal bond issuances?
Good question. I'd like to do that. You know, I suspect that there is likely to be a fairly significant crowding out in the municipal market for a couple of reasons. One is, remember that unlike today, treasuries were tax exempt during this period of time. So they were treated in a fashion similar to municipals in terms of tax treatment. So I would expect there to be closer degree of substitutability, or municipals being viewed as a closer substitute for treasuries than they are in today's market.
Okay, and probably last question at this time. Could you explain a bit more the methodology, how methodology addresses the indigeneity issue? Do you mean that there were no factors that affected both unsold corporate debt amount and government debt issuance?
Well, so again, I think that the issue here is the identification strategy. I kind of think about it as akin to almost an event study, where you're looking at an unexpected increase in the demand for government bonds, partly because of the novelty of these issues, but also the way they were marketed. Remember, if I go up here, I have, we don't know how much demand is going to be taken out of the market during these Liberty Bond offerings. We know the size at the time of the offering it begins, but we don't have, this, which is the amount to which they're oversubscribed. And this is an important feature, because the way in which you acquired these in the direct marketing campaign was through placing an order that you weren't uncertain as to whether that order would be filled in whole or in part. So during the time in which the offering is outstanding, you don't know whether your offer is going to be filled or not, and thus that's likely to impact an investor's willingness to invest in corporate securities until that uncertainty is resolved.
Okay, thank you. Let's move on.
Sure. One of the things I think is interesting is that, there seems to be a dynamic going on here. So you can see in this chart, what we do here is we estimate the what we call dynamic coefficients, which is just the unsold ratios by month. And the chart shows the point estimates and the confidence intervals. And what you notice is that there's a general trend, I see it, towards a smaller impact as experience with the Treasury marketing improved. And you can also see that in the extent to which the oversubscription rates decline. Now, as I indicated, we try to do some robustness checks. One is, we add additional extra firm controls, things like profitability, tangibility. It reduces the sample size, but really doesn't impact the basic conclusions in terms of the qualitative relationships. We do observe some differences between control firms and treated firms. So control firms would be firms that are issuing during the Liberty Bond issues, whereas treated firms are those that are issuing outside of the period in which the Liberty Bonds are being marketed. One of the differences we observe is that the control firms tend to be less profitable than the treated. That may suggest that there is a greater need for the control firms to for financing, and thus were less likely to be able to postpone their offering. If that is true, we're likely to understate the impact of crowding out. So we try to address this issue by estimating a weighted least squares, where we're going to weight by the propensity score calculated by the propensity to issue during the Liberty period versus otherwise. And we find very similar results to the ones that I just shared with you. We look at a shorter treatment window. We use securities offerings only where we have Moody's news, as opposed to offerings that we obtained information from the Capital Committee reports. Again, the results for these robustness checks are similar to what I showed you. So let's talk a little bit about mechanism here, and then we'll talk about maturity choice, and then I'll finish up. So the literature on crowding out and its impact on corporate financing decisions sort of is based on an idea that securities or markets are segmented, that investors have demand for fixed income securities with specific attributes. So the Krista Murphy and Singh Jordan talk about securities for which are more money-like. The Greenwood papers look at what's called a gap-filling hypothesis, which is basically that corporates fill the gap in terms of the maturities that the government is segments that the government is not issuing in. So if the Treasury begins issuing 20 years and reduces its issuance of, say, 10 years Treasuries, then firms respond by scaling back their 20-year issues and increasing their issuance of 10 years to meet the demand by investors in a particular segment. The arguments regarding market segmentation are looking at securities that are likely to be close substitutes for U.S. Treasuries. So going to distinguish between investment grade versus non-investment grade securities. So one of the things we look at is how federal debt affects corporate bond issues by maturity and rating, and whether those effects differ between the various Liberty Bond campaigns. So recall that the first, second, and fourth Liberty Bond campaigns were bond issues where the government issued long-term debt of 20 plus years, whereas the third and fifth issues were issuances of relatively shorter term debt. The last issue was 4 years, and the third Liberty Bond campaign consisted of 10-year bonds. And the takeaway from this chart is as follows. We see a significant impact in the long end of the corporate bond market for high-rated firms. We see very little effect on, short-term bonds. In fact, the sign switches, the larger impact on longer-term bonds when the Treasury is active in the long end of the market, and less so when the Treasury is in the short end of the market. The other thing we look at is whether government debt and common stocks are viewed as substitutes for one another. And this idea really is motivated by recent work by Hartzmark and Solomon, who find evidence from looking at disposition effects, changes in mutual fund holdings, that investors really don't view capital gains and dividends as substitutes. So they provide evidence of what they refer to as the free dividend fallacy. So you look at a stock paying a high dividend and you say, geez, that high dividend looks a lot like an interest payment on a bond, and forget the fact that high dividends are mechanically lead to a reduction in capital gains. So they have a price impact. So when evaluating returns on dividend paying stocks, investors tend to focus only on price changes and not evaluate total returns. So they kind of view the dividend as sort of a sort of an interest payment, as opposed to a payment that will impact the price performance of the stock. So to investigate that, whether investors are viewing these dividend paying stocks as close substitute for government bonds, we again sort of estimate this model where we have a treatment period when there's new federal debt relative to GDP being issued. And we then distinguish between common dividend paying or common stocks with smooth dividend payments. So we're thinking typically of utilities or railroad stocks, low growth, high dividend yields, relative to stocks issued by industrials, either paying no dividend or a dividend that fluctuates with cash flows. And what we observe, as seen here, is that the impact of government debt issuance on stock issuances is really in the for the companies with smooth dividends, and it's particularly pronounced during the periods in which the government is issuing very long-dated bonds, less so in the periods in which short-term bonds are being issued. So we kind of view this as evidence consistent with the hypothesis that investors view high, stable, dividend-paying stocks as close substitutes for government bonds. Now, the natural question that you might have at this point is, well, did firms adjust their securities offerings in response to a shift in demand? So do we observe changes during the war years in the decision to issue bonds of various maturities? And we look at that question using both a linear model of maturity choice as well as a multinomial logit of a maturity choice, similar to one that Dominique Bauder and myself used in a recent paper. Let me just focus on the investment grade and speculative grade in the linear model. So what happens to the maturity of issuances during the war years as opposed to during the pre and post-war era? And what you can see is that firms reduced significantly the maturity of their bond offerings. And that reduction was greatest for investment grade issuers than non-investment grade issuers, which is, I think, very surprising if you're going to shift the maturity composition of your debt. There's less rollover risk associated with a short-term debt issuance by an investment grade credit than a speculative grade credit. And so we would expect that if the Treasury issuances is adversely affecting or impacting the maturity choice, that it would be in the very in the long end of the market by investment grade firms, and which is exactly what we find. I'm going to skip over the multinomial logit and talk a little bit about relevance, and then open it up for some additional questions. So, the questions that, when I started this project or began working on the project, the question was, to what extent is the world of World War I informing me of the world of 2019 or 2018? And, we look at sort of the standard sort of questions, is the tax system a lot different today than it was back in World War I in terms of the tax treatment of corporate securities? Back in World War I, there was an interest tax deduction for corporate bonds at the corporate level. There was a advantage for dividends at the personal level, not so for capital gains. Capital gains were taxed at the normal or regular tax rate. Dividends were exempt from what was called the normal tax. And for those of you familiar with this era, during World War I, there was a fairly rapid increase in taxes. So the government raised not the normal tax rate, which is the tax rate that applied prior to the war, but they implemented what it was called a surplus tax to partly fund the war effort. And dividends were not exempt for that from the excess tax, nor were interest on corporate bonds. So you still had a tax advantage of dividends relative to interest income, and dividends were clearly advantaged relative to capital gains. So interest on Liberty bonds, as I mentioned, was for most of the issues were exempt from individual taxes. So Liberty bonds were tax advantage relative to corporate bonds. So perhaps that tax advantage would lead to a greater substitution away from corporates and to liberties. And as somebody mentioned, it's likely to have an impact on municipal debt issuances during this period of time as well. During World War I, both treasury bonds and corporate securities were almost entirely held by domestic investors. So unlike today, where a lot of treasury bonds and debt is held by foreign entities, and thus that tends to soften or mitigate any impact treasury issues have, or the impact of treasury issues on corporate investment domestically. During World War I, the investment was almost entirely by domestic investors. So that would likely lead to a larger impact. Granted, at the time, government debt was a much smaller portion of GDP than during World War I. The other issue that you need to think about in terms of how to evaluate the evidence that was provided is that, the Liberty Bond campaigns were campaigns to promote investment and savings by appealing to investor patriotism. So as I showed you the slide of the parade in Philadelphia and the colorful posters that are behind me here is one that, with a sort of a theme of patriotism and, we're likely to increase savings rates. And there's evidence that indicates that for many investors, it was their first venture into investing in bonds and investments other than in a bank account. So that would likely to mitigate any impact of crowding out. So let me stop here. Ask for some more questions. I think I have 5 or 10 more minutes.
Yeah, we have about 10 more minutes left, so let me kind of read some questions for you. So following on earlier questions about real effects of crowding out, do treated firms cut down their investments? If so, is it necessarily bad since we don't know if these were going to be positive NPV investments? Does crowding out affect firms' choice between short-term and long-term investments?
So it's something to look into whether there was an impact on firm investment. I think that's a question that's a broader and perhaps even more important question than the one we're addressing here. Our focus here is on really using the unique circumstances of markets in World War I to get some evidence as to what investors view as close substitutes for Treasury debt. We didn't dig down into as you mentioned, the real effects of whether firms, the extent to which investment spending was postponed, or the long run impact of government borrowing on the private sector capital investment or capital stock.
Okay. Given the high oversubscription rates, why there would be any crowding out? This seems to suggest huge pent up and apparently unmet demand for fixed term securities. So shouldn't be much crowding out, right?
No. So think about it this way. The oversubscription, say, of 52%. So I've got a $3 billion offering. Okay. Investors have subscribed and thus put off investment of 52% more than that. So the impact of the offering on demand is 1.5 times larger than the offering itself.
Okay. Regarding real crowding out, what does the government do with the money it raised? If it uses the money to pay companies to make ammunition and tanks, for example, it's not obvious that this causes any crowding out in the real economy.
Oh, I don't disagree. I mean, I think that the question, if you're thinking about crowding out as crowding out a private investment, and this is again one of the problems that people have had in trying to determine sort of the impact of government borrowing on corporate finance, or the more general topic of crowding out in terms of investment, is that you have a couple of things going on. You have government borrowing combined with increased government spending, obviously, in the case of, say, World War I, which is going to impact demand and thus may, if there's considerable slack within the economy, increase real investment. Lesser so in the case of, when you're close to full employment and you try to do increase government spending, you're going to shift the mix of investment and spending, but not likely to have as great an impact on investment.
To what extent is the difference between the expected issue amount and the actual amount driven by a revision of expectations of funding needs by the firms? Secondly, what is the impact of this crowding out on investment? Does the methodology control for firm financing deficits?
So the short answer is yes and yes. So we have controls for profitability, which is, we don't have investment spending, but we have profitability. So that's going to give you some indication of the financing deficit. So, you know, what we're sort of exploiting is differences in the impact across various securities types. So if what the impact of the Liberty bond campaigns were is basically, look, companies just postpone their investment spending, and thus they don't issue as much. We would see the unsold ratios increasing, but we wouldn't observe necessarily the unsold ratios changing in the pattern that we see, which is more so for longer term debt, particularly when the government is issuing long-term debt, or for dividend paying stocks versus short term. And you know, you might argue that part of the difference between speculative and investment grade firms is due to differences in their needs for funds. But remember, these are campaigns that were begun and were ongoing during the Liberty. So we're able to observe the demand, or at least a portion of the demand, for these companies for funds. So I don't think it's a difference necessarily in the firm's demand for funding as opposed to it is investors' demand for various types of securities.
All right, thank you. In the interest of time, let's proceed, and we have about 5 minutes left. Thank you.
Well, that's good because I only have about 2 minutes left of presentation. So I'm going to just conclude. I think that, and then hopefully I can have time for a couple more questions. I think that, you know, we're able through this experiment to see both the firm's demand for an investor supply of financing. So this discrete, irregular, unpredictable treasury debt issue combined with the way in which companies issued securities at the time allows us a unique opportunity to gauge the degree to which investors perceive various types of corporate securities as substitutes for substitutes, yeah, for government debt. So I kind of think of where this paper sits within the literature. As you're aware, the Graham, Leary, and Roberts paper suggests that an important determinant of debt issuances is, and the use of leverage, is the extent to which the government is using leverage to finance its operations. So they find that when government borrowing relative to GDP increases, which is a measure of government leverage, they see a pattern of decreases in corporate leverage. You know, obviously, observing those patterns doesn't, you know, indicate causation, and there's a number of other factors that may impact those patterns. I think by identifying specific intervals in which there's an increase in the demand for, or supply, sorry, of government securities combined with, again, the way in which securities were marketed, gives us an opportunity to measure the degree to which various types of corporates are viewed by investors as substitutes for government debt. That's all I have here.
All right, and I think we're actually done with questions. I think all questions have been asked before. So let me then conclude this presentation and thank Chris for a very insightful presentation. And I hope you all enjoyed it. Thank you very much for joining us today. And please don't forget to join us next. So next week we will not be having a seminar because there is a Western Finance conference. But on June 30th, we're going to have Claire Sellerie from University of Toronto. So please come back in 2 weeks to join our seminar series again. In the meantime, again, let's thank Chris for very insightful and informative presentation, and see you next time.
Thank you.